Last minute, Fed minutes released. Here is the first reaction of Bitcoin. The Fed has released the minutes of its recent meeting, which could provide more clues about the central bank's thoughts on inflation and interest rate hikes, and the price of Bitcoin, BTC, has reacted. Here is the content of the minutes. Fed officials supported slowing the rate of rate hikes. Fed members are predicting a higher peak for the ultimate interest rate target. There is a big uncertainty for the final interest rate, Fed members said, adding that more data is needed. Some Fed members said tight monetary policy was in line with risk management, while others said that excessive tightening increased some risks. Respondents agreed that there was little sign that inflationary pressure was easing. With the release of the data, an increase in the price of Bitcoin was observed. Chart showing the rise in BTC price. The Fed raised interest rates by 75 basis points at its November 2 meeting. The Fed raised interest rates by 75 points at its November 2 meeting, marking its fourth increase of this magnitude. However, Fed Chairman Jerome Powell suggested at a press conference that the institution may soon begin to slow the rate of interest rate hikes. Other Fed members, especially Vice President Lael Brainerd, have also hinted in this direction in their recent speeches. But the signals from other Fed officials, who continue to stress that inflation remains high and need to be contained, have been confusing. According to futures contracts in the CME prior to the release of the Fed minutes, investors are currently pricing in a 71% chance that the Fed will raise interest rates by just 50% at its December 14 meeting. That's higher than the 50-point increase of 52% a month ago, but less likely than the 50-point increase of 85% priced in last week. Recently released inflation reports show that the pace of price increases is finally starting to slow to more manageable levels. Although the most recently announced applications for unemployment benefits have increased compared to a week ago, the employment market in the U.S. continues to be relatively healthy. But as long as the labor market remains robust and inflationary pressures continue to subside, the Fed will likely reduce the magnitude of the rate hikes. Some experts worry that if the Fed goes too far in interest rates, the increases could eventually slow the economy too much, potentially leading to much higher unemployment, job losses, and even a recession. Asterisk not investment advice.